So, big news on the financial front for India. In 2025, a whole new blueprint is being rolled out, the Income Tax Act. Now, I know what you're thinking, tax law, complex jargon, but let's just forget all that for a minute. At its heart, this is the master plan for the country's finances. And today, we're going to break down exactly how it all fits together.
So let's start with a question that sounds simple but is actually super important. How does the government actually see your income? Because this new act isn't just some long list of rules about how much tax you have to pay. It's really a system of organization, a framework that's designed to categorize every single rupee that moves through the economy.
And this is the document that makes it all official. Its purpose is to consolidate and amend the law, which is really just a formal way of saying it's designed to clean house, updating and streamlining the entire system. And the go-live date for this new rulebook, April 1st, 2026. From that day on, this is what governs the nation's finances.
All right, first things first. Before we can even think about reading this blueprint, we've got to learn the language. Just like any architectural plan, Chapter I of the Act lays out all the key definitions. And if we don't get the terms right, the rest of the structure won't make any sense.
Okay, let's start with a big one you're going to see all over the place, assessee. It sounds super technical, right? But it's actually really simple. Section 2, subsection 11, defines it as, well, anyone who has to pay tax. Basically, if you pay taxes, this act has a special name for you. You're an assessee.
All right, next up, income. Now, we all have a pretty good idea of what income is, right? But believe me, the Act's definition, found in Section 249, is way broader than you might think. It's not just your salary or business profits. It also covers things like dividends and even donations made to a nonprofit. It just goes to show how wide a net the government casts.
And that leads us to a really crucial concept, especially when we talk about wealth and investments, the capital asset. Section 222 defines this as pretty much any kind of property that you, the SSE, hold. It could be real estate, stocks, bonds. It's designed to be a very broad category.
But, and this is key, the blueprint is just as specific about what a capital asset isn't. For instance, if you're a business, the inventory you plan to sell, your stock in trade, that doesn't count. Your personal belongings, like your clothes or furniture, are also out. And very importantly, most agricultural land in India is also specifically excluded from this definition.
And, speaking of that agricultural land, this is where you really see how incredibly detailed this blueprint gets. It's kind of wild, actually. Whether or not a plot of land is considered a capital asset can literally depend on how far it is from a city and how many people live in that city. It's proof that in this blueprint, the details matter. A lot.
Okay, so we've got the lingo down. Now we can finally look at the actual architecture of this thing. The entire Income Tax Act is built on a foundation of 5 central pillars. This is the core structure that holds the whole system together. And here they are, the 5 heads of income. Honestly, you can just think of them as 5 big buckets. Every single rupee of income you earn has to be sorted into one of these 5 categories. Salaries, income from house property, profits from business or profession, capital gains, and then there's this catch-all bucket, income from other sources. That's for anything that doesn't fit neatly into the first 4, like winning the lottery or interest you earn from a savings account.
So for this next part, let's grab a magnifying glass and put that income under the microscope. We're going to zoom in on a few of these pillars to see the specific, nitty-gritty rules that apply to each one.
We're going to kick things off with the big one, the pillar that applies to most people out there, salaries. This is covered in sections 15 and 16, and it's the primary category for the huge majority of the workforce. So what exactly does the government count as a salary?
Well, the Act makes it super clear that salary is a whole lot more than just the money that hits your bank account each month. It also includes things like your wages, any pension you receive, commissions, and even perquisites, which is just a fancy word for perks, like a company car or health benefits. If you get it from your employer, chances are it falls under this pillar.
All right, pillar number 2 is income from house property. If you own a place and rent it out, doesn't matter if it's a house, a flat, or even a shop, this section is for you. Section 20 gives this kind of income its very own chapter with its own set of rules.
And check this out. This is a perfect example of how each pillar plays by its own rules. Under Section 22, for house property income, you automatically get to deduct a flat 30% from your rental income. This is for repairs, maintenance, you name it, no receipts needed, no questions asked. It's a clear, simple rule that shows the blueprint in action.
Moving on to Pillar 3, we're talking about profits and gains of business or profession.
So this is the playbook for all the entrepreneurs, the freelancers, the doctors, the lawyers, basically anyone who isn't earning a regular salary. Section 26 lays out all the rules for business income. And again, the details here are super specific. Get this, Section 28 says that if you have a business expense over 10,000 rupees that you pay to one person in one day, you can't pay it in cash if you want to claim it as a deduction. It has to be done through the banking system. It's a small rule, but it's designed to keep things transparent.
Okay. Pillar number 4 is capital gains. And this is where everything kind of comes full circle, right? It connects right back to that term we learned at the very beginning, capital asset. This whole section, Section 67, is all about the profit you make when you sell one of those assets. See? Told you those definitions were important?
The Act spells it out pretty plainly. It says any profit from the transfer, which just means sale, of a capital asset gets taxed under this specific heading. So what does that actually mean? It just means if you sell an asset, like property or stocks, for more than you paid for it, that profit gets its own special treatment and is taxed under its own set of rules.
All right, we've gone through the language, we've walked around the pillars. What's the big takeaway here? What does all this blueprint stuff actually mean for you and me?
When you zoom out, the big picture is actually pretty clear. First, the Income Tax Act isn't just a list of taxes. It's an organizational blueprint. It uses very specific language, like assessee and capital asset, to make sure everyone's on the same page. Then it sorts every kind of income into one of those 5 heads. And the most important part? Each of those heads has its own detailed rulebook.
So that leaves us with one last question for you to think about. Now that you know the blueprint of the house, which one of these 5 rooms, salaries, house property, business, capital gains, or other sources, does your income live in?
Because at the end of the day, look, nobody expects you to become a tax expert overnight. That's not the point. The point is to understand the structure. Because once you can see the blueprint, you can start to navigate your own finances with a whole lot more clarity and a whole lot more confidence.